This is our second pass at Trumponomics. We did it in December, and we're going to do it again now. And this is a work in progress. As you pick up the paper, everything changes every day, and there's lots and lots of moving parts. We've just got the healthcare part, which who knows where that's going to go, where the whole right wing of the Republican Party came out against it. So it isn't clear whether there's votes in the House or the Senate for the current plan. We didn't get into healthcare in this report because we had no idea what the program was going to be until yesterday, and this was done before that. But the thing is what's going on in the country is we call this extreme makeover edition. So you know, the thing is to the extent that some of these plans happen and if you wait 4 years or so, the country could look a lot different in 4 years than the way it looks now, because some of these proposals are radical radical in a neutral sense, saying it's fundamental changes in the way we do economic policy with respect to income taxation, corporate taxation, and trade. So this is all up in the air. So we'll see how much of an extreme makeover we're going to have. Okay. All right. The main themes we have is you know, despite a very rocky start, we still think we're going to get a total of about $5 trillion in tax cuts over 10 years. And the differences between this time and last time is last time we thought the tax cuts would take effect in the third quarter of this year. Now we think it's going to be in the first quarter of 2018. So we pushed it back 6 months because it doesn't look like it's possible logistically within the Congress to get a tax bill passed that quickly. Now some of it might be retroactive to 2017, which we don't know yet. But there's yet to be a tax bill introduced, so we have no idea what that's going to be. But if you get these kinds of tax cuts, you get $1 trillion deficit. The risks are growing with respect to trade and immigration. And those are non-trivial risks. And for the time being, we're assuming we're not going to have a big trade war and we're not going to have mass deportations, but who knows. And the other thing is we get a short spurt in growth in 2018 to 3%, but that fades in 2019, and we're going to get higher interest rates and higher inflation. And that's what we had last time. And the consumption, defense, and equipment are going to be the leaders in powering growth, and the weaker will be the housing sector will not be as strong. And we said that last time. All right. Now I want to update people is the stock market on the election. It's very obvious. You can see right here. This is the day before election. The day before election day, the market's been straight up, and the stock market believes in reflating the economy, believes in big cuts in corporate taxes, big cuts in individual taxes, a big increase in corporate profits, and that's why the stock market has gone straight up. The thing is, and similarly, the bond market reacted the same way initially, where the Treasury yields went from 175 to 250, but they've since flattened out. Now today, the bond market 10-year Treasuries is 257, you know, the highest it's been in a long time. Is the ADP report for employment for the month of February was released, which is a private sector guesstimate of what the government will officially report on Friday, and they said 300,000 jobs for February. Huge numbers, and bonds immediately sold off on that. The fact is the bond market has been skeptical of the reflation coming from the Trump economy. It's much more skeptical than the stock market. So there's a non-confirmation. Similarly, the foreign exchange markets, the dollar index went call it forget that one-day thing from 97 to 104, and that's also flattened out. So the foreign exchange market isn't as also ebullient about we're going to have this big reflation, we're going to have this stronger economic growth, big tax cuts, a big increase in corporate profits, higher returns to capital. Foreign exchange market is also skeptical. So the thing is what you see everybody says looks at the stock market, and stock market is saying everything is great, but two other markets which are actually bigger than the stock market, the bond market and the currency markets, are more skeptical of Trumponomics than what you would have from just looking at the stock market alone. And we'll see what happens if bond yields go over 260 and if the dollar advances over 104. But there's still skepticism in the other markets. So just don't think there's a party going on Wall Street. The party's in the stock market, but it's not in the bond market. It's really not in the It's not in the currency market. Now the other thing is there's something called a border tax, which is technically called a destination-based cash flow tax. We don't think that this is sort of like, this is not, for that in particular, this is sort of like a 20% wall tax, but they're talking about a 20% border tax. And these are two Trumpies basically all upset that their Corona will go up 20% and the margaritas will go up 20% in price. So that's why it's called Big Trouble in Margaritaville. All right, this is what, in very simple terms, is a destination-based cash flow taxes. Exporters are helped. There'll be no tax, corporate income tax, on exports. So when Boeing sells an airplane, or Hollywood sells a movie to England or to Japan, that export, there would be no corporate tax associated with those revenues. So it's a huge tax cut for exporters. However, imports imports are not a tax deduction. Imports will not be deductible for tax purposes. So when Walmart buys a whole shipload of clothing from China and spends like $1 billion on that shipload, that $1 billion wouldn't be counted as a corporate expense for Walmart. And so they think, why? They're going to have to raise prices. Because all of a sudden that will no longer be deductible, and Walmart works on a 3% margin, so they have to raise prices. The theory is, and this is only an economic theory, is that the dollar will rise significantly to prevent a price increase to the consumer, but Walmart still faces a tax problem. So the feeling is that consumer prices are going to go up. All the prices of all imports probably will rise, not by the full amount of the 20% tax, but by some amount, and that'll generate a domestic inflation. Needless to say, the retailers are lobbying like crazy against it, and the exporters like Boeing and Caterpillar and General Electric are lobbying like crazy for it. But it's such a big rewrite of the tax code, we don't think it's going to happen. It's too much to do too fast. So we think we're going to end up with a broad corporate tax cut with expensing of at least capital equipment. So when a corporation buys a machine, it'll be fully deductible in the year they buy it. There'll be no depreciation. Depreciation goes away, goes out of the tax code, at least for equipment. It may also be true for buildings. If that happens for buildings, then we get all kinds of distortions. We'll start building buildings for tax purposes and end up in trouble. Our sense is when all this is done, it'll be the Lawyers and Accountants Relief Act of 2017. And in the meantime, in Washington, D.C., it'll be the Leave No Lobbyists Behind Act, because this will send, the lobbying on the border tax will send lots of kids to college. This will pay lots of tuition on it, because the money flowing into K Street right now is just unfathomable. The amount of money being spent on lobbying right now, just around the border tax. Forgetting about all the lobbying that's going to go on around the health care bill, forgetting about all the lobbying that's going to go on around trade. So this is, if the campaign was to drain the swamp is filling, the swamp is filling up. All right, in this environment, the deficit goes to $1 trillion, and it will stay there. And the other thing that's going to happen is the Federal Reserve is going to get more aggressive. Now, Janet Yellen said a couple of things the other days. She talked about normalizing interest rates. Normalizing interest rates, in Yellen speaks, means a federal funds rate of 1.5% to 2%. And the federal funds rate right now is around 0.5%. It's going to go up next week. Now you can go to the bank on that the Fed funds rate will go up next week. And the other thing, she said she didn't think she was behind the curve. And whenever a Federal Reserve official says they're not behind the curve, it means they're behind the curve. Okay, that's what it means. They say once they deny something like that, it means it's happening. So we think we're going to get. The market's been saying like 3 rate increases this year. We think it'd be 4 or 5. And the other thing we think is on Friday we get the official employment report. And one of the things that happened in January, which was very strange, wages were only up 0.1% in January on the official numbers, and finance wages were down 1% in a month, which strains all credulity. Our sense is that we're going to get a very big increase in the wage number on Friday, maybe 0.6%, 0.7%, or they'll revise up January. It'll be one or the other, and that's going to send a wave through the Federal Reserve and through the bond market that will not be pretty. So that's what we're looking for on Friday. So wage inflation, instead of being benign, is going to be much higher than what the market now thinks. So if you look at our forecast, we have the funds rate ending the year roughly around 2%, which is much higher than we are now, just a little bit below it, 3% in 2018. And the 10-year Treasury ends the year, which is now 2.57, ends the year at 3. And then it goes to 4 in 2018, so it'll be in a higher interest rate world. And the other thing on the Federal Reserve is there are 3 vacancies effective April 1st. So the Janet Yellen Fed is going to be different because there are 2 vacancies right now who Trump could name. Knock, knock. He hasn't named anybody, so we don't have a clue. Our sense is it won't be economists. So sorry, Ed, I don't think you're going to make it. I don't think you're going to make the cut this time. And then there's a 3rd vacancy in April, and Janet Yellen's term expires in January 18, and Stanley Fischer's term expires in June 18. So it looks like we're going to have we're going to have an extreme makeover in the Federal Reserve Board. So whatever you think about whatever you think about Federal Reserve policy for the past 5 or 6 years, which have been pretty consistent, it's going to be a lot different. How different, we'll find out. We'll see who the nominees are. But he's yet to name a nominee, and he has 2 nominees he could name tomorrow and hasn't done it. So that's going to be a big change, and we will see that once we see who he nominates. We'll have some sense as to where Fed policy is going, but we think they'll not definitely, but highly likely they will raise interest rates next week. All right, this is our GDP forecast. We get a spike. That spike is the first quarter of 2018 when a tax cut, and then it fades. And the reason is when you're at full employment and the labor force is growing at less than 1% a year, and productivity, which has been growing very slow at around 1% a year, it's hard to get to 3% because labor force growth plus productivity equals GDP growth. So you got to assume a productivity miracle. We are not in the faith-based economics here, so we're not making a faith-based thing. We're going to assume 2% to 2.5% productivity, so that's why growth fades. If the deregulation and the tax cuts and all of that other stuff spurs an increase in productivity, terrific. But we're not making that assumption, and the long-term budget assumptions that the Trump people are making, they're going to assume 3% growth for the next 10 years, and that assumes a productivity miracle. And maybe we'll have self-driving cars, maybe we'll have all these things, but I don't know whether we'll have them in 2 years or 3 years. But they have to implicitly be assuming a productivity miracle to get 3% growth when the economy is already at full employment. We could have done it a few years ago when we had a lot of slack, but we don't have slack anymore. All right, employment growth, robust. If ADP is close to right, this is on track. If we get the 300,000 kind of number, or 250, we get a big number on Friday. On track, it'll slow in 2019. Unemployment could get down to 4%. Now, Jerry could talk about immigration and deportations. If you get a lot, then it'll go below that. If you get a lot of deportations, unemployment could drop below that. But employment growth will also be slower and stuff like that. But we have it going to 4%. It goes up in 19 because the economy is slowing, but it's still very low. Inflation moves higher above the Fed target. They use something called the PCE in the consumption deflator in the GDP accounts. This is a CPI, which we see every month, and core and headline. And we're already over 2%. And our guess is it's going to be 2.5% to 3% inflation going forward. And on the Fed measure, the corporate consumption deflated, that'll be over 2% on a year-over-year basis by June, something like that. So the Fed's going to be at their target for employment. They're going to be at their target for inflation, and say they have to normalize. They have to start normalizing rates. So at least we're going to be 2% by sometime in 2018, and we think a little bit higher. All right, wage growth also looks like it's on the road to 4%. The number that we got in January, which gives us this drop there, we think that was a fluke. So we'll find out on Friday if that was a fluke or not. The most important number on Friday is not going to be the unemployment rate. It's not going to be the change in non-farm payrolls. It is going to be the change in average hourly wages. That's the most important number to look for when they release the report on Friday. And the markets are going to move on that number and not on the other two numbers. All right, tax cut is going to get a consumer boom, especially in 2018. You drop money on lots of people. A lot of it's going to be spent. But also the savings rate's going to go up because most of the tax cut on the personal side will go to higher income people rather than lower income people, so more of that will get saved. So savings rate goes up to 7% in 18 and in 19. But it still be a reasonably good economy. Housing, we have stalling. And we had a debate about that yesterday in our seminar. We've been historically looking to get up to 1,500,000 housing starts. And that would be sort of normalized housing starts, what we've had for the last 40, 50 years, consistent with household formation and everything else like that. But our sense is if we didn't get a housing boom last summer, when rates were 3.5%, mortgage rates were 3.5%, unemployment was below 5%, creating 200,000 jobs a month, and we weren't igniting a housing boom in that environment, it's hard for us to see when employment growth will be 150,000, not 200,000 a month, and mortgage rates will be 5.5 instead of 3.5 to ignite a housing boom. We hope we're wrong here. If this goes to 1.4 million, the economy would be much better than what we're forecasting. So we think housing tops out at around 1.3 million, or just under that, and then rolls over gradually as higher rates begin to bite into new starts. And the other thing is on multifamily, what the multifamily developers have been doing, they've been building high-end housing, and they finally woke up to the fact that there's a limited market for how many people could pay $3,500 a month for a one-bedroom apartment, and that's a thin market, and there's a glut, so we don't think it's going to be made up for a big increase in multifamily starts, because rents are actually falling in Los Angeles and San Francisco and New York, Boston, for high-end apartments. For more affordable apartments, rents are still going up. Okay, equipment spending rebounds, coming from the tax cuts and coming from the end of the oil collapse, because oil capital spending is now on the rise. The high dollar plus rising consumption will suck in imports. And yesterday we had record trade deficit. The trade deficit was the highest since 2012. The United States reported. So all the talk about, you take a look at the policy, if the dollar goes up and you have a big tax cut, what it does is imports all of a sudden look cheaper because of the higher dollar. You have more money in people's pockets coming from the tax cuts. Where do we spend the money? We spend the money in imports. So we bring in lots of imports. So imports are going to start to be much stronger. And the problem is on the export side, export growth is going to be minimal because the high dollar makes our stuff more expensive. So, and so we, therefore, is the trade deficit, instead of contracting under Trumponomics, the trade deficit is going to expand. And that's the kind of environment that we're looking for. So trade continues to be a problem despite all the rhetoric. Now here the risk is this is where the trade wars start, and this is the sort of risk of trade wars. When the Trumpies see all of this stuff, they'll say, wait, we got to do something. It's not a border tax. They want to do tariffs. They want to do non-tariff barriers, all kinds of things, and we can have a problem. But I don't think that's going to happen, because one of the things, the president's been saying lots of things in the past 2 months. But one of the things he talked about a lot during the campaign, he's been silent on for the past 2 months. China. Hasn't said a word about China. And if there's a trade war issue, it's going to be with China, and he hasn't said a word. So my sense is I don't think we're going to have a trade war. Now here's NAFTA, and NAFTA is really a big deal, because with Mexico, we import $309 billion, and we export $236 billion, and lots of stuff goes back and forth. The thing is, it isn't only the direct trade flows on goods. It is all the jobs associated here domestically with warehouses and moving things and logistics and finance and insurance and what have you. So if we start messing with NAFTA, not only do we have these trade flows get messed up with, all the ancillary stuff that's done domestically, a lot of which is done in California, Texas, along the Southwest, all that stuff begins to roll over. So it's a big deal. With Canada, we were more balanced. It's 280, we export and we import 312, and there's also a lot of cross-border stuff. So NAFTA is, if you look at this, in total trade flows, you got something like $1 trillion, imports plus exports in both places. So messing with NAFTA is a big deal. Now conceptually, there's nothing wrong with amending NAFTA. NAFTA was written in 1994, hasn't been amended. There was no real internet in 1994. There's all kinds of different intellectual properties. So if we had normal people doing it, it would probably be a good idea to take another look at NAFTA. But if you look at it, say we want to totally revise it, the Mexicans aren't going to go along with a one-way switch on NAFTA. But conceptually, to take another look at NAFTA is a good idea, because there's a lot of kinks, because it wasn't perfect in 1994, and time has changed, so it should be updated. But the thing is, how it's done is it could be a big deal. And then lastly here is one thing I think there'll be bipartisan support in Congress is going to be on increases in defense spending. So we have, after going down 6 years, we have defense spending on the rise in 2018, 2019, and 27, and this year too. And these are going to be substantial increases. That'll be good locally here in California. And I think there'll be broad bipartisan support, because the Democrats right now have discovered a new villain, and the new villain is Mr. Putin. So it's going to be very hard for them to argue. If the Russians are so bad, it's going to be very hard to argue against increasing defense spending. And Trump is going to say we have to support the troops and what have you. So our sense is where you normally might get a partisan fight on defense spending, you're not going to get it. You're not going to get it this year, and this will sail through as part of the as part of the budget, and that's the mostly domestic spending. So that's going to be one of the forces for growth over the next 2 or 3 years. And the defense stocks on Wall Street have been on a tear in anticipating this. So to conclude is we're going to get, we think, big tax cuts. We're going to get a temporary growth spurt. Don't think we're going to get a border tax, because that's just going to be way too complicated. And the thing is, on the border tax, one more thing. Those of you who watch Saturday Night Live, there was an anti-border tax ad run on television. So it shows you the lobbying is already beginning. That's nothing to do with what they said on Saturday Night Live. Is the anti-border tax people ran an ad on Saturday Night Live. So you're going to be seeing more ads on both sides of it, saying great for exports, or consumer prices are going to go up by 20% if they pass it. So there's going to be a lot of activity on that. We see higher inflation and a more aggressive Fed. We see consumer defense and equipment strong. Housing is going to be weak, and trade is going to be weaker. We've modeled in on our model. We went into our model to deal with some potential retaliation. We arbitrarily cut aircraft exports from what they normally would have been, and farm exports, because we figure those are the two choke points politically for the United States. So if somebody's going to retaliate against the United States, it's going to be with aircraft and it's going to be with farm products. And because the farm state senators will go up in arms, and Boeing and all the aircraft subcontractors around the country will go lobby Congress on that. So we've arbitrarily lowered exports, but for farm products and for aircraft. And then the risks are rising. But the big risk right now is trade, because we still don't know. And the other risk is immigration, and we don't know what the impact of that's going to be on the labor force from the point of view of the economy. So that's it. Thank you.